What does the impending recession mean for your investments? Nothing. Absolutely nothing. Well, there's kind of one caveat to that. The coming recession means absolutely nothing to your portfolio if you're a value investor. If you've been YOLOing your portfolio into stocks like Rivian or Coinbase, or maybe the extent of your investment research is following a couple of Jeremy's stocks to buy videos, then you probably do have something to be concerned about. In all seriousness, the global economy is deteriorating pretty quickly, and all signs point to a recession, either shallow or deep, hitting us pretty soon. Despite that, over the past few months, I've had the most fun researching and investing in companies than I have in a very long time. Today, I want to talk about why and how you can too. Also, you'll want to stick around to the end in this one because I have a new free investing resource that I want to share with you that will help you make better investment decisions. There's a lot of factors driving us headfirst into a recession, and while the details of some of these factors is not the purpose of this video, I do want to give you a quick summary of what is going on so that you can at a top level understand what you should expect going forward. There's really two key things that are happening in the markets at the moment that are driving us towards a recession. The first is surging inflation, followed by the Federal Reserve stopping inflation with higher interest rates. Ever since the onset of the pandemic in March of 2020, there has been a perfect storm of factors creating a high inflation environment. There are many factors, but some of the biggest ones include the trillions of dollars that the US government spent on stimulus, which was entirely funded by near 0% interest debt purchased by the Federal Reserve with freshly created money. There's been global supply bottlenecks on semiconductors and on shipping and freight services, and massive labor shortages with demand surging as we get back to normal. And the final nails in the coffin are the conflict between Russia and Ukraine, driving up oil prices around the world, and China's persistent lockdowns causing even more supply shortages.
It is ships queuing around Shanghai, many sitting idle due to China's zero-tolerance approach to COVID.
This perfect storm of economic events is driving the 8.3% inflation rate seen in the US and the 9% rate just recorded in the UK. And since annual inflation in the US actually came down a little bit this month, many people are suggesting that the decline in annual inflation is an indication of its peak, but actually core inflation accelerated in April. And while their guess is as good as mine, or maybe a better way to phrase it is their guess is as uninformed as mine, just hoping that inflation magically goes away is precisely the reason why inflation has surged to the highest level in nearly 40 years. But there is a solution here. We have the Federal Reserve who has the ability to raise interest rates enough to curb demand. The problem is that almost every time that interest rates have been risen to reduce inflation, it has caused a recession. And that's simply because raising of interest rates increases the borrowing cost for governments, for businesses, and for households, essentially meaning that people tend to save more and spend less. Unfortunately, this process often means that businesses make less profit and then lay off staff in order to reduce their costs, then just fueling even more saving and less spending. But what happens to the stock market if the US goes into a recession? This is a pretty important question to think about right now, since the US already saw one quarter of GDP contraction, and just one more means that technically the US would be in a recession. Well, the stock market isn't actually tied to the economy, at least not one for one. I like Benjamin Graham's definition of how the stock market functions. He says that in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. In the short term, stocks reflect investors voting on short-term events. In other words, they reflect the expectations of investors rather than the reality of what is occurring. This is why the stock market was surging during the worst part of the pandemic in early 2021. Despite there being peak cases and peak deaths at that time, investors could see the light at the end of the tunnel, and as a result, they voted in the market with their dollars. All of this is to say that even though the US isn't technically in a recession yet, investors are voting with their dollars in anticipation of it, and that's why the stock market has been declining over the past couple of months. Ironically, the decline in the stock market, especially if it's severe, actually can induce or make a recession much more likely to occur, since a decline in stock prices significantly hurts the wealth of people and essentially means that people may end up spending less money, inducing the recession that they were expecting to occur anyway. But what most people don't get, even incredibly smart people investing in the markets, is that you don't need to know what's going to happen with the economy. To finish the rest of Benjamin Graham's quote, over the long term, the stock market is a weighing machine, meaning over the long term, stock prices reflect the value of the underlying business. Let me explain. Let's say we knew there was a business that would return $1,000 to us over the next 10 years. And let's also assume for this example that there's no alternative investment opportunities. This is our investment opportunity. Well, in that case, a business that returns $1,000 to us is worth about $1,000. If I was to buy that business for $250, I would be pretty happy about that. That's going to be about a 15% per year return over the next decade. If I took that offer and I bought that business for $250 and then the next day some fool off the street said he would buy the business from me for $100, would I care? No. Why on earth would I care what some random person is willing to pay for the business when I know that I'm going to be quadrupling my money over the next decade? The secret truth about the stock market is that it is filled with people who have no idea what the businesses they're trading are actually worth. And as a result, they're willing to pay far too much for businesses in some cases and sell them for far too less in other cases. Let's use that same example, but pretend instead that you have no idea what the business is worth. You've just paid $250 for the business, you don't know what you're going to get out of it, the market is coming down, and someone has just come up to you and said, hey, I'll buy that business from you for $100. You would probably panic. Did I make a mistake? Should I not have bought this business for $250? And then maybe the next day someone offers you $50 and you're really panicking now, and as a result you end up selling that business for less than what you originally paid for it. Now you might think this is ridiculous behavior that only a small pocket of the market acts like, but you would be wrong. This is actually how the vast majority of people investing behave, including fund managers. Yes, I said it. Most fund managers don't know how to value businesses and often end up reacting like this when there is significant volatility in the market. And the crazy thing is, for some businesses, not all, but for some businesses, it's actually relatively easy to figure out what they're worth. And if you couple that with a calm and rational temperament, you can do pretty well over time navigating the market while everyone else is panicking. So let me get to the punchline here. Value investing is your ticket to stress-free stock picking. And I recently put together a complete checklist of the things to research and analyze for a business that help us ensure really two things. One is that the business we're buying is of high quality, and two, that we're paying an appropriate price for that business. You can download the full checklist via the link in the description below, or just head over to www.hamishhodder.com/checklist. The checklist is broken up into 4 key sections: circle of competence, economic moat, management, and intrinsic valuation. And this is essentially a collection of principles that I've learned over the past few years from the likes of Warren Buffett, Charlie Munger, Phil Fisher, and many other value investors. The first section, circle of competence, is like the foundation of your analysis and research process. It's in this section that you determine whether you've learned enough about the business or whether it's one that you put into the too hard basket and move on to try and analyze some other kind of company. Within this section, there's 5 things that you need to deeply understand. You need to know the fundamental economics of the business. How does it make money? How does it source and distribute its products and services? What expenses does the business need to pay to operate? And which ones are variable and fixed? What are the capital requirements for maintaining the business and for growing the business? And what's management's plan for growing the business going forward? Then there's the key business indicators, which help us understand the performance of the business in absolute terms, but also relative to other competition. And then you need to understand the industry, the competitive landscape, and the risks associated with the business. If you can achieve a thorough understanding of the business, then the second section is economic moat. Does the business have a deep advantage protecting it from competition? I look for 8 types of economic moats in businesses, and for each of them, there's a different way of assessing qualitatively and quantitatively whether a business has the moat and how strong it is. I have a video on economic moats if you want to learn more about them. The third section is to assess management, the people making decisions in the business on our behalf. I'm looking for 4 things here: honesty and integrity, value alignment, effective capital allocation, and strong financial health. For example, one of the keys here is that we're looking for businesses that consistently generate a high return on invested capital, and in combination with that, they generate a high return on incrementally invested capital, essentially meaning they have an opportunity or an avenue to take profit generated and reinvest it back into the business to compound earnings over time. The final section, which should not be attempted without a business passing the first 3 sections, is intrinsic valuation. This is where we use the key business indicators, our understanding of the business's economics, the industry, the competitive landscape, and much more to estimate what the future cash flows of the business might be. This is the step where most people let themselves down, because it's not enough just to look at past growth and extrapolate that growth into the future. For example, you need to consider things like the capital that is required for the business to actually grow. Take a restaurant chain, for example. You might just at a basic level project, oh, this business can grow at 10 or 15% per year. Okay, but how many restaurants do they need to open for them to achieve that and be at the position you expect in 10 years' time? And how much is it going to cost them to build out each of those restaurants? At a very, very basic level, if a business is producing $100 million in profit and it costs $10 million to open each restaurant, then it would be silly to project much more than 10 restaurant openings per year, at least in the first couple of years. Of course, the business could use debt or raise equity capital in order to amplify their growth and grow at a faster rate and invest more money than they're actually producing, but relying on that is a quick way to be disappointed in the long-term performance of the business. The bottom line here is that analyzing businesses is hard. It's doable, but it's hard. And you don't have to pick individual businesses. You should only be doing this if you get a thorough amount of enjoyment from it and you are willing to put in the effort that's required to research and analyze companies deeply. But if that is you, then the volatility we're seeing in the market right now makes the best time to invest. Because right now we're seeing a time when there are many high quality businesses that are potentially undervalued because of the short-term pain going on in the stock market. And that means that there is a broader amount of businesses that you can analyze and potentially invest your money into. As I mentioned, if you want to download the full checklist for yourself and have it on your computer, then you can. First link in the description below, or you can head directly over to my website. And just one other thing, I've also been on Twitter a little bit more active on Twitter. So if you're looking for some content from me in between the YouTube videos that I put out week by week, then feel free to go ahead and follow me over there on Twitter. Let me know your thoughts down in the comment section and hit subscribe if you want to stay up to date with content that I post in the future. With that said, hope you guys have a great rest of your week.